After that report, I'm here in the studio with Ashwinder R. Singh to address some of the questions many of you have been asking. This is the Clarity Corner, and Ashwinder R. Singh will help us in breaking it down for you. So, I have quick questions for you. Let me ask you the first one. For someone looking to sell their property, one of the biggest challenge is pricing it right. How can a seller realistically determine the right price for their home?
Now, the right price isn't what you want. It's what the market will pay today. Benchmark against recent sales within 1-2 kilometers, not just listing. Real buyers pay for usability and not nostalgia. Another point to keep in mind is, as a seller, if you price your properties 5-7% below the perceived market rate, the property sells 3 times faster. Yes, it sells 3 times faster. In real estate, time is money and liquidity is the new luxury. Remember, liquidity will always score more than anything else in real estate.
There's been a lot of conversation around interest rates. Do you think the recent rate cut will actually translate into higher housing sales?
Well, I want to tell you that the world has changed, Indian buyer has changed, and it is all about sentiments. And rate cut is no more the sole driver. Buyers move when jobs, confidence, and supply of real estate aligns. India's housing market is now aspiration driven. It is more aspiration sensitive, not rate sensitive. The new buyer fortunately responds more to lifestyle than to loan rates. I think we give far more importance to rate cuts than we should. Earlier, this was not the case, but now the Indian home buyer and real estate investor is far more evolved.
We've seen steady momentum in the luxury housing segment. Do you expect this demand to continue over the next few years?
Yes, luxury demand is driven by wealth formalization and not speculation. People need to understand that. Buyers are mostly end users, not flippers. And that is why luxury demand is going to be good. Luxury today means privacy, wellness, and design. It's a secular demand story and not a cyclical one. People have become aspirational. They want a good quality of life. They need good amenities. They need a good standard of living. That's why the luxury demand, according to me, is going to remain consistent, sustainable, and thrive. Why just for 3 years, but maybe for the next decade?
And finally, many people see real estate as a long-term investment. Does investing in property still offer the potential for stable passive income?
The 3 pillars of passive income are rental yield, co-investment, and fractional ownership. In today's time and age, all are strengthened by technology, platforms, and blockchain. The smartest investors, according to me, build cash flow before capital gain, rent before resale, yield before the yield curve. Real estate is a great asset class for passive income, but it is also a great asset class for capital appreciation along with passive income. If you keep real estate as a long-term asset class investment instrument, in 10 years, you'll be surprised that it has given more returns than any other asset class ever, whether it is equity, whether it is gold, or anything else. So yes, these are the 3 things you can keep in mind while choosing real estate as a passive income instrument.
Thank you so much, Mr. Ashwinder R. Singh, for joining us here today on R.Estate, Building the Nation.